Hello guys, and welcome to another video. My name is Mark, I'm an entrepreneur and property investor, and in today's video we're talking about some bad news that has just come out which could drastically affect property prices in 2025 and 2026. And I am of course talking about the Fed's decision to reduce interest rates by 0.25% as expected, but it's the commentary that has really tumbled and spooked markets. So if you look at the S&P 500, down 3.5%, FTSE this week down a similar number. So why does this really matter to us back in the UK? And why does this really affect house price growth going into 2025 and 2026? Now, before I get into that, give this video a big like. It does help me out with the algorithm. And if you haven't already subscribed, consider subscribing. It only takes a click of a button. And if you look in the description, you can book a free one-to-one call with me. Until I get to 10,000 subscribers, they're absolutely free of charge. 15 minutes, we can talk about whatever you would like. Now, the Fed, as I said, has reduced interest rates by 0.25%. as expected, but the commentary is the bit that matters. They have said that they expect, because inflation is being more stubborn, to only make 2 base rate cuts next year of 0.25 each time. Now, the Bank of England, to reach its own target rate of 3.75, would have to cut rates 4 times at 0.25%, and that would bring us drastically beneath the interest rate set by the Fed if those 2 predictions were to come true. Why does that matter? In that scenario, the dollar will strengthen, the pound will weaken, and because most of the global commodities, oil, gas, well, let's just use oil and gas as the first 2 examples because they power our cars, they power our power stations, they provide us with electricity, they power the factories, they power the businesses that produce goods and provide services. So let's just use those 2 as a great example. Well, those costs will rise because even if the cost per dollar stays the same, the cost per pound will be more expensive. And that will put increased pressure on people who provide those goods and services and businesses, as well as people who heat their own home and fuel their own car. And that will lead to rising inflation as people and businesses will have to put prices up in order to cope with those new costs. Now, scale that out throughout the entire economy. Scale that out with most commodities. So we're talking food, we're talking energy, we're talking raw materials for building, we're talking almost everything being priced in dollars globally. It's a major contributing factor to potentially rising inflation next year. Add that to the fact that we have a Labour government that's come in and essentially said we're going to borrow loads of money, we're going to tax people more, and we're going to spend that money. Well, that also could raise inflation. And Bank of England's mandate is to bring inflation down to under 2%. Now, house prices in the UK really have had a sort of split over the last couple of years. If you look Midlands and above, house price growth has been there. We're talking about my properties up in Wellingborough, Kettering and Corbury. They've all had mediocre growth. My properties in Sheffield have had fantastic growth. And that is because affordability on those mortgage side isn't really taking effect. If you take into consideration a flat or a small house in Sheffield for £100,000, well, you've got a £75,000 mortgage on that as a buy-to-let investor. Even if we considered you were a first-time buyer and you bought for 110, you got a £100,000 mortgage. Let's use that example for the average working person. Well, that mortgage rate on £100,000, if it was 6%, is £500 a month. At 3%, it's going to be £250 a month. Now, that's the interest-only contribution. The repayment will be dependent on the term of the mortgage and everything else. But the interest is going to be £500 a month or £250 a month. Well, that isn't a massive difference, right? Whereas if you look at the same flat or small house in London, well, maybe they've got a £400,000 mortgage on it. And instead of it being £500 of interest, it's going to be £2,000 of interest. Well, it makes a huge difference, that 2,000 going down to 1,000 in nominal terms, not in percentage terms, but in nominal terms. And this is where the big divide has happened, because nominally, pay down south hasn't risen enough to make the difference in those interest rates. Whereas up north, nominally, not percentage-wise, nominally, it has. And that's supported house price growth over the last 2 years. Now, my expectation for 2025 on my last video, which came out probably yesterday, by the time I'm filming this, predicted that with lower interest rates in 2025, house price growth in those more expensive areas will start to pick up. Today, I'm thinking, well, if the Bank of England can't reduce those interest rates to even 3.75, and I was thinking that they might be able to go even lower with a weaker economy, and let's face it, the economy is shrinking, it's grinding. I can feel it. I run a transportation business. I can tell you firsthand, consumers are cutting back, people are moving around less. It is happening at the ground level. I can see it every single day. We could enter a technical recession next quarter. I mean, this quarter at the moment is zero growth. By the end of the quarter, it's quite potentially going to be negative growth. And quarter one in 2025, we could enter a technical recession. Does that support house price growth? In my opinion, not unless Bank of England is able to cut those interest rates. And if the Fed isn't doing it, all they're going to do is add fuel to a fire if they cut interest rates to support people, but the price of their goods and services just skyrockets because of this new added inflation. It's going to be a rock and a hard place. The globe and the world needs to move together like they did at the beginning of the interest rate rise. Everybody rose together and then everybody's bringing it back together. But the Fed have announced, and as the world's leading and largest economy, and with most of the commodities being traded in dollars, it is highly likely that whatever they do, we will have to follow. So this is, of course, negative outlook for UK property prices in 2025. Do I still believe that the northern areas, the areas where the average house price is much cheaper, those £100,000 to £150,000 houses, I mean, I think they've still got so much scope to go. I think there's so much affordability there. And the minimum wage rising to £12.50 in April means that the minimum wage job has suddenly become £26,000. The average salary in the UK is only £30,000. A minimum wage job is almost an average salary job. And I can see under this Labour government that we are just creating two classes of people. Workers and people who earn minimum wage and have an average job. And then we have the haves, the people that have got big salaries, and any impact to be felt by any of these budget changes just isn't going to touch them whatsoever. Now, the risk you run by increasing taxes on entrepreneurs and the generators of wealth is that they leave the country. And I'm a prime example. I've left the country. I've moved over to Dubai because I got to a point where actually the UK is not that business friendly, in my opinion. Much friendlier over in Dubai for businesses. The tax rate is much lower. It's 10% if you make more than about $100,000 a year on corporation tax, and anything I pay myself as a salary is absolutely zero tax. Now, we do pay tax, but it's not called tax, it's called fees. So we pay fees for residency, we pay fees for business licenses, we pay all these other fees. And it amounts to about a flat rate per person per year of about £3,000 or £4,000 or £5,000. Add in medical insurance on top, it's going to be somewhere in that region. But that's a flat rate per person. So I could earn and pay myself in a salary over £1 million and I would still only pay the fees that are the same for everybody. So guys, that's a little bit of my opinion. I think there's a rock and a hard place for the Bank of England when it comes to house price growth. I think for the government it's even more difficult because where are they going to raise any more money from? Are they going to tax working people more than they've decided to do? And I know they haven't. I know the national insurance is aimed only at employers, but where do they think that money is going to be taken out from? When I look at my wage bill for my staff, I don't just consider their wage. I consider their wage, my employer's NI, my pension contributions for them. I don't parcel it out and say they're completely different. That's a different cost. No. That's the cost of that member of staff. Every business that I know operates the same. When they cost up a member of staff, they include all of the costs, including their paid leave, so that you can see exactly what that member of staff is costing you per year. And I think that is why this government is potentially going to be the most hated government in recent history. So guys, what are your thoughts when it comes to 2025? Does the Fed actually matter? I think it really does. I think it's going to hold back any cuts that the Bank of England can do beyond the rate of what the Fed does. So guys, I'm starting to take a more negative outlook, but only on the more expensive properties. Up north, Midlands, anything less than £200,000 for a 2-3 bedroom home, I still think you're golden for some house price growth in 2025, 2026. What's your opinion? Put it in the comments, reply to every single one, and I'll see you on the next video. Cheers guys.